You shake hands on $2 million for your business. Then you watch 600,000 of it vanish before the money ever reaches your account. Nobody stole it. Almost every owner I meet finds out where it went at the very end of the deal, when it's already too late to do anything about it. I'm James Bill. I've built and sold businesses for most of my working life. This channel exists to get owners like you out of yours with the money intact. Here's the whole map, so you've got it even if you stop watching early. When you're selling a business, tax comes down to three things. The first is how the deal is structured. The second is what the price gets assigned to on paper. The third is where you live and when you get paid. All three are negotiable. Owners lose six figures on every one of them because they treat tax as something the accountant tidies up after the price is agreed. Start with the structure because it moves the most money. There are two ways to sell a company. You can sell the assets, which means the buyer takes your equipment, your customer list, your name, and your goodwill. Or you can sell the stock, which means the buyer takes the whole company as it stands, history and all. Buyers almost always push for an asset sale. It lets them write the price off over time, and it leaves the old company's problems behind with you. Sellers usually do better on a stock sale. The gain is normally treated as a capital gain, and that carries a lower rate than ordinary income. Here's the part worth remembering. At the top federal level, a long-term capital gain is taxed at 20%. Ordinary income at the top runs to 37%. That gap is the whole ball game. On a $2 million gain, it's worth more than $200,000 to you. There's one more layer. Higher earners also pay a net investment income tax of 3.8% on investment gains. So the realistic federal number on a good structure sits just under 24%. Now let's say the buyer wins that argument. You're doing an asset sale, which is what happens most of the time with private companies. You're not finished because what comes next is allocation. It's the quietest six-figure decision in your whole deal. In an asset sale, the price gets split across the things you're selling. Some goes to equipment, some goes to the building, some goes to goodwill, which is the value of the business beyond its physical parts. Each of those buckets is taxed differently in your hands. Goodwill is the bucket you want because it's normally a capital gain. Equipment is the bucket that hurts. If you've been writing that equipment down for years, the tax code takes those deductions back when you sell. That recaptured amount gets taxed as ordinary income right at the top of the scale. Buildings have their own rule where the depreciation you claimed is taxed at up to 25%. Your buyer wants the opposite of what you want. Every dollar they put into equipment, they can deduct quickly, so they'll push hard to load that bucket. Both of you have to report the same split to the government on the same form, so nobody can quietly fix it afterwards. This gets negotiated once, usually late at night, usually by people who are tired. Get your accountant into that specific conversation and do it before the letter of intent is signed. Before I give you the last piece, do one thing this week that costs you nothing. Ask your accountant to run a simple exercise. Take the number you're hoping to sell for. Have them tell you what you'd actually keep today, under the structure you've got right now. Most owners have never seen that figure written down. I walk through how to ask for it in my free Exit Readiness Playbook, and the link sits right below this video. The owners who see that number early are the ones who still have time to change it. The third lever is the one people forget, and it comes in two halves. The first half is your state. State tax on a business sale runs from nothing at all to well over 10%. California takes up to 13.3%. Texas and Florida take nothing. On a $2 million gain, that difference is worth more than $250,000. States look very closely at owners who relocate right before a sale, so treat this one carefully. If a move was already part of your retirement plan, the order you do things in matters enormously. The second half is timing. If you take the whole price in 1 year, a big slice of it gets taxed at the top rate. Often the buyer pays you over several years, especially where you're financing part of the sale yourself. The gain can then be spread across those years and taxed more gently as it arrives. There's a catch you need to know about. That recaptured equipment depreciation is generally taxed in the year of the sale. However, the payments are spread. So you can owe tax on money you haven't been paid yet, and owners get caught by that every single year. If you remember one thing from this video, make it this. Your tax outcome gets decided at the letter of intent. By the time you reach the closing table, it's already fixed. By the time the lawyers draft the final agreement, the structure is set, the allocation is roughly agreed, and your options have quietly closed behind you. The letter of intent is where structure and allocation first appear on paper, and it's the last moment you've got real leverage. Most owners send that document to their accountant after they've signed it. Send it before, and one afternoon of your accountant's time can be worth more than everything else you do in the sale. So here's the whole thing in 3 lines. Structure decides your rate, so fight for stock or price the difference into the deal. Allocation decides how much of your price gets taxed as ordinary income, so negotiate it with your accountant in the room. Timing and your state decide what's left, so plan both of those before you sign anything. If you're somewhere on this road, I put together something that'll help. It's called the Exit Readiness Playbook, and it walks through the same 8 steps I use with owners. It covers getting a defensible value on your business and understanding what you'd really keep after tax. It's free, and the link is right below this video. There's also a way to book half an hour with me if you'd rather talk it through. The price you agree is a headline. The number that matters is the one that reaches your account after everyone else has been paid. Those 2 numbers can sit 6 figures apart, and the distance between them is set months before anyone signs. Get your accountant into the room while the structure is still soft. That one decision is usually worth more than every dollar you manage to negotiate onto the price.